Welcome to today's presentation. My name is Alice Hogue and I'll be your instructor. Today we're going to be talking about federal taxes on oil and gas income. But before we begin, since this is the last webinar that I'm going to be doing for Module 6, and for those of you that have taken all 6 modules, I've saved my favorite Cajun joke for last. So this is how it goes, and I need to write on this, so I'm going to have to use my my bamboo pad. But let's see, the two main characters are Boudreaux and Thibodeau. Okay, so here we go with the accent. Thibodeau decided he was going to start an oil and gas business, and he decided what he really needed was a division order analyst. So he put a sign in the window, and he says, wanted division order analyst. So here come Boudreaux, man, that damn stupid Boudreaux come along. He sees the sign, he says, hey, Thibodeau, hey, I want to apply for the job. I want to be a division order analyst, me. And Thibodeau says, man, what I'm going to do, I don't want this idiot to be in my oil and gas company. So he doesn't want to insult him. So he says, okay, Boudreaux, well, you can't just come in here, and come off the street and be a division order analyst. Man, you have to know something about math, You have to know how to add and subtract. He says, I'm going to have to give you a little test to make sure you're qualified. So Boudreaux says, oh, that's fine, Thibodeau, that's fine. So he gives him a piece of paper and a pencil. He says, okay, Boudreaux, question number 1, I want you to represent the numeral 3 without using any numbers. So, man, Boudreaux had to think about that. He said, man, I got to write the number 3 without using no numerals? So he taught and he taught and he taught, and he said, aye, I got it. And this is what he wrote on his paper. And man, Thibodeau looked at that. He said, man, what is that? And Boudreaux says, oh, well, you told me to represent the number 3. 1, 2, 3. That's a tree. So, man, Thibodeau, he's going, oh, what am I going to do with this guy here? He says, okay, Boudreaux, yeah, that's a tree. Okay. Now I want you to represent the numeral 33 without using any numerals. So, once again, Boudreaux, he had to think and think and think. And finally, he said, aye, I got it. And this is what he drew on his paper. And Thibodeau looked at that. He says, man, what the hell is that? And Boudreaux says, oh, that's a dirty tree. There's some dirt on that tree. That's 31, 32, dirty tree. So, man, by this time, man, oh, Thibodeau, he's just rolling his eyes, him at this damn Boudreaux. So he says, man, I got to do better than this. I got to think of something that's not divisible by tree, because he's just going to keep using these damn trees unless I come up with something that's not divisible by tree. So he says, okay, Boudreaux, listen, if you're a division order analyst, you can't just come off the street and be a division order analyst. You got to understand math. You got to understand everything has to equal 100. And so what I want you to represent then, Boudreaux, is I want you to represent the numeral 100 without using any numbers. Oh, man, no. Boudreaux, he got a problem, him. Man, he don't know how to represent that because he can't use no trees. And so he thought and he thought and he thought and he said, aye, I got it. And this is what he drew on his paper. Drew 1 tree, 2 trees, and he did this on each of the trees. And then he drew a little circle at the bottom of each of those trees. Thibodeau said, man, what the hell is that? And Boudreaux said, my little dog came along, he pooped at the bottom of each of these trees. That's dirty tree and a turd, dirty tree and a turd, dirty tree and a turd. Now that equals 100. When can I start the job? Oh, I'm so glad y'all enjoyed that. Like I said, that is my favorite Cajun joke, one of my favorites that I like to tell at conferences and stuff. Okay, so now let's look at something that's not as fun or as funny, but I think it is interesting, and that is federal taxes on oil and gas. So as many of you know, our chosen industry is one that can bring great risk or great reward. So one of the advantages of our tax code, the U.S. tax code, is that many of these risks are mitigated by allowing for tax deductions and tax shelters to encourage the development of our nation's natural resources. So, for example, these large upfront deductions for what we call intangible drilling costs are available for deduction immediately in the year incurred. And we're going to talk about this later in the presentation, but that's a major incentive for people to invest in oil and gas properties, is this upfront deductions for intangible drilling costs. So what is the federal government's interest in developing our natural resources? Well, simply put, domestic oil and gas helps make our country more energy self-sufficient and reduces our imports on foreign oil. We're basically reducing the reliance that we have to depend on people who basically don't like us, other countries that don't like us. So we want to maximize the natural resources that we have in the United States. And so Congress has provided tax incentives to stimulate this domestic natural gas and oil production by private sources. So in other words, the tax benefits that we're going to talk about today are designed to encourage participation in oil and gas ventures by not only oil and gas companies, but by investors. And there are many oil and gas investment opportunities to create and build wealth in the oil and gas energy sector. That's why you see a lot of times, like when I was working at Anadarko, there were a lot of movie stars. There were like Marlon Brandon and Betty Davis, I think her name was, and they were all investing in oil and gas properties. And one of the main reasons is because of these significant tax shelters. So we'll talk about what those are in a minute. But I just want to give you a quote from a company called Breitling Oil and Gas, and they're breitlingoilandgas.com. They are for people that make over $1 million and want to invest in oil and gas properties. They can go to this website and they'll send them a packet to show how you can invest in oil and gas. But the quote from them is, quote, "An immense market and the promise of continuing growth are why oil and gas is such a sure investment." So that may sound ridiculous to us in the oil and gas industry who are very well aware of the risk, but I'm going to show you how these tax shelters, these tax deductions, can greatly minimize the risk, not only for oil and gas companies, but for investors. So let's begin with our agenda. The first thing I want to talk about is the different types of accounting methods. There's cash basis accounting method and accrual basis. Now most of our companies that we know, ExxonMobil and all the majors, use this cash basis. But I want to talk about the distinction between those two different types. And then I want to talk about the general rules of how to determine whether or not something is depreciated or depleted or expensed. This is what you need to memorize if you're studying for the AAPL exam. I'm going to cover it in the introduction, and I'm also going to cover it in the final notes to make sure you have it. The next item we'll talk about on the agenda is capitalized or expensed. We need to determine whether certain items are capitalized or are they expensed. So we'll give you the definition of what capitalized is, what expensed is, and then we'll talk about which categories each of the costs for drilling an oil and gas lease will fall into, an oil and gas well will fall into. And then there are some costs that can be in either column, and I'm going to go through that with you depending on, for example, one is lease cost. If we actually lease the land, that's going to be expensed. If we don't lease the land, that's going to be capitalized. So we'll go through those items. So there's things that can be either capitalized or expensed, and then there are items that can go in both columns depending on what the fact pattern is. And then there are what we call intangible drilling costs. Those are the top costs associated with drilling that can be deducted in the year incurred, and they're significant. They're like, I think one statistic I saw said 65 to 80% of the costs of intangible drilling costs can be deducted in the year earned. So intangible drilling costs can be either capitalized or expensed, and the person who is incurring the cost gets to make a one-time deduction or election whether they want it capitalized or expensed. So then we're going to go out, if we say, okay, we want those items to be capitalized, we're going to talk about the different types of capitalization of those items, namely depreciation. We're all familiar with that. That's our car or our house depreciates over time. But there is a type of capitalized category that is unique to the oil and gas industry, and that is depletion. That specifically when we're talking about the purchase of reserves, those reserves can be depleted or amortized over time, or is capitalized, amortized over time. But there's two different types of depletion. There's cost depletion, and then there's percentage depletion. So we're going to go over those two different types, and we're going to talk about what the distinction is between them. Then I'm going to talk basically a little bit about active versus passive income, another major inducement for people to invest in oil and gas. And then, as I said, we're going to go over the final notes again. Those are the things you need to know for the AAPL exam. And we'll go over those once again. Basically, that equipment and production reserves are capitalized and salaries are expensed. So let's begin with an introduction. This is from the AAPL Land and Reference Guide. And what it says is that if you spend $1 to produce income, that dollar becomes a deduction against the income it produces. That is the general guideline for tax deductions, especially when we're talking about business tax deductions. So for example, I incur a cost to present these webinars. It's $99 a month, and that would be $1 that I spend to produce income. So that $99 can be deducted against whatever income I produce. That's the general principle of tax deductions for businesses. If you spend $1 to produce income, that dollar should become a deduction against the income it produces. That's another one of the great reasons. Really, when I started my own business, I did not realize all the tax benefits of having your own business, and that's one of them, that you get to deduct all of these costs incurred to produce income. So the question then becomes, well, when do we take this deduction? And the answer is it depends on what accounting method your company uses and whether the deduction is for items that improve or increase the value of the property. That is things like equipment or the construction of office buildings, or if your company buys oil reserves that are in the ground, those can be amortized over time. Or items that are cost incurred for other expenditures cannot be amortized. That is, they can't be written off against income in the year of the expenditure. So let's first look at the different accounting methods, and then we'll go over the distinction between expensed items and capitalized items. So there's two types of accounting methods, and your company can choose whether they want to be a cash basis or an accrual basis. Now, most companies, the ExxonMobils of the world, all the major oil and gas companies are what we use the cash basis accounting methods, and they are known as cash basis taxpayers. And what that means is that revenue is accounted for in the year it is received, and costs are paid in the year, or accounted for in the year paid. So cash basis means if you pay for it this year, you get a deduction this year. If you incur a cost this year, you get to deduct that cost this year. Accrual basis, on the other hand, is just the opposite. That is, revenue is accounted for when it's earned and deduction is claimed when it is owed. So under an accrual basis taxpayer, an accrual basis accounting method, if you owe, if you're entitled to, let's say that you have a promissory note that a business partner gives you. That promissory note can be accrued over time, even though you don't actually receive it. So accrual basis is whenever you receive that promissory note, not when that promissory note is paid. So a cash basis taxpayer reports income and deductions in the year that they're actually paid, and accrual basis taxpayers can report receivables as income and deduct promissory notes as payment, even though they don't actually incur the income right away. So you could deduct, for example, all your delay rentals before they are due under an accrual basis taxpayer. But if you're a cash basis taxpayer, your delay rentals are paid in the year that it's incurred. Again, it's a pretty, it's just something that you need to know. We're not going to go into a lot of detail on it, but for the most part, most oil and gas companies are cash basis. But I just want you to know that there is a distinction between the two different types. So if you are a cash basis, you can take the deduction in the year that the cost is incurred. If you are an accrual basis taxpayer, you can take the deduction once before the delay rental payments are due or before the payments are actually due. Okay, now let's go over the general rules. And the general rules is that there's two types of expenditures in the IRS tax code, specifically when we're talking about business. And that is, we have capitalized expenses, or it's either capitalized or expensed are the two categories, capitalized or expensed. Sorry about that. So if they're capitalized, there's two different methods of capitalizing something. That is depreciation. That's for things like equipment. And when we think of something that's being capitalized, we're thinking that it's being paid out over time. So, for example, your house would be depreciated over a 30-year term, or the office building that you build could be amortized, cost taken over a 30-year period. But when we talk about oil and gas, we have a unique category of capitalized items that is called depletion. Depletion is if you have a number of barrels of oil in the ground, those reserves are going to be depleted or removed from the ground, and that is a different type of capitalization. I'm going to show you how it works in a minute. But just for now, you need to know that there is equipment that is depreciated, production is depleted, and salaries are always expensed. If you're reading from the AAPL text, they go over this and over this and over this. So they want to make sure that you know equipment is depreciated, like your car or your house or a tank battery. That's depreciated over time if it's capitalized, and the production reserves are depleted. They're capitalized and they're depleted. But salaries are always, always expensed. So let's look at the two different categories of capitalized or expensed. When we say something is expensed, that's just an ordinary and necessary business expense. It's not tied to any given property or equipment. So, for example, the fee for my webinar subscription, that's going to be expensed. That's not going to be amortized over the life of my computer, for example. It's a business expense that occurs in the year that it's incurred, and you can deduct it in the year that it's incurred. But it's not tied to a given property or equipment. My computer, however, would be something that is capitalized. That is something that's paid to increase or improve the value of the property or value of my business in this case. So it's expensed if it's an ordinary and necessary business expense that's not associated with particular property or equipment, and it's capitalized if it's tied to a given property or equipment, or if it's paid to increase or improve the value of the property. So the key question is whether an item can be expensed, that is paid when incurred, or capitalized, paid over time. So we need to decide whether to capitalize or expense these items. So these are general categories, so whether it's capitalized or expensed. So generally speaking, things like tangible equipment, these are things that are tied to property or equipment. Those are going to be amortized over a period of time. Think about a car would be an example. That's going to be capitalized over a period of time. Things like tangible equipment, tangible well cost, oil reserves that you purchase in the ground, an office building, a casing for a well, tanks, pumpers. That's all equipment that can be amortized over a period of time. So that's what we call tangible, things you can touch, feel, see, tangible equipment that's associated with the cost of drilling the well. Expensed items, on the other hand, are deductible in the year paid if you're a cash basis taxpayer. So it's things like salaries, and your text goes on over and over that salaries are always expensed. Lease operating expenses, so that is like a bonus payment or a delay rental payment. Those are considered lease operating expenses. Those are going to be expensed in the year incurred. Office rent, not the office building itself, but the payment of rent. Payment for utility or for phone or for office supplies, that's all going to be expensed. And again, labor is also going to be expensed in the year that it's incurred. So note the distinction between capitalized or expensed. Capitalized, if you'll just think about, we're talking about equipment, and expensed is we're talking about things that you can't touch, feel, you have to have an understanding about it. What is a salary? What is a bonus? What is a delay rental payment? It's not a piece of equipment like the items that are capitalized. Now, some things can be in both categories. So some things like G&G land costs can be either capitalized or expensed depending on the fact pattern. So geological and geophysical land costs could be capitalized or it could be expensed. Lease options, if you're going to include in a lease option, depending on whether or not that option is exercised, that could be either considered capitalized or expensed. And it's expensed if it is exercised. If it's not, it's capitalized. And then surface damages can also be capitalized or expensed depending on how the surface damages occurred. So for example, surface damages like if you're drilling, those are expensed. If it's for seismic cost, it's going to be capitalized. And then the last but not least is IDCs. IDCs are what we call intangible drilling costs, those costs that are associated with drilling the well. And this is a huge tax incentive for people, is these intangible drilling costs. So let me show you how these other items can be in either category. So when we're talking about geological and geophysical land fees, if the leases are actually bought, those leases are capitalized over a period of time. So your delay rental payments are going to be capitalized over the primary term. If there's no leases that are bought, you did hire a broker, you had people shoot seismic and do work on the land, but let's say they never thought that it would be about a valid play. In that case, no leases were bought. Those items can be expensed in the year incurred. But if the leases are actually bought, the costs associated with those leases will be capitalized. Another example of an item that can be in either category, depending on the fact pattern, is lease options. If the lease options are exercised, that is, we actually make a payment to the landowner to add to the number of years in the primary term. If we do actually make that payment is going to be capitalized over the life of the lease. If we have lease options but we never expense them, but let's say we had to pay extra bonus because we wanted to get these lease options, that extra bonus would be, if we don't exercise the lease option, the extra bonus would be expensed. Surface damages is another example of something that can be in either the capitalized or expense category, depending again on the fact pattern. So if the damages to the surface were caused because of drilling, because we were actually drilling a well, those surface damage costs, what we're going to pay to the landowner for the damages that we caused to the land, those are going to be expensed. And so if we're a taxpayer, a cash basis taxpayer, we can take those deductions in the year that it's incurred. But if the surface damages are for the shooting of seismic, and we may or may not actually drill on that land, those surface damages would then be capitalized over a period of time, usually the life of the well, but if we never drill, it could be over sometimes the IRS will give a category of, like, for example, an office building is amortized over a 30-year period. So the IRS can come up with their own determinations of how many years it takes to amortize something. So that's what they might do in the case of seismic. Now, intangible drilling costs can be either capitalized or expensed depending on how the operator elects to take those deductions. So let's look at what intangible drilling costs are. Intangible drilling costs are, when we talk about intangible, they're the opposite of equipment. So anything that's equipment is going to be like a tangible cost. But an intangible cost is going to be things like labor and chemicals and mud and grease. It could also be like the building of roads, for example, the cost associated with drilling the pad for the rig to go on, the cost of trucking the equipment into the drill pad, into and out of, ingress and egress away from the drill pad. Any kind of drilling cost, any kind of perfing cost, any kind of fracking cost, and any kind of equipment that's put in the well. That means like steel and pipe, all that stuff is considered intangible expenditures because it's put in the well. So the advantages of having a intangible drilling cost is that 65, this was the number I gave you earlier, 65 to 80% of the well cost can be deducted because that's what intangible expenditures are for a well. It's 65 to 80% of the cost of drilling a well fall into this category of intangible drilling costs. The advantage is that it's 100% deductible during year one. So as an example, if you have a $100,000 investment, that would yield you up to, let's say, $75,000 in tax deductions between this 65 and 80, $75,000 in tax deduction. So you're really only risking a dry hole is really going to only cost you $25,000 and not the $100,000. Why? Because these intangible drilling costs can be deducted during year one. Now let's look at whether or not these are capitalized or expensed. So under the IRS code, the operator can make a one-time election whether they want the intangible drilling cost to be expensed or capitalized. Now most elect to expense because they want to take that deduction in the year that it's incurred. Then there is a secondary election that for every well you can decide, you have to make a decision on each well drilled whether you're going to expense all of it in the year that you drill it or whether you're going to expense part of it and capitalize or amortize the rest of it. So this is a lifetime election here. I want it to be expensed. If you elect that you want it expensed, then for every well, you have to make this secondary election that says, I either want to expense all of it in the year drilled, or I want to expense part and capitalize part. So that's really a nice election because you really are getting the advantage of part of it being expensed and part of it being capitalized, but you can say as much as you want to be expensed during the year drilled. Okay, then we have capitalized items, two different types. There's one called depreciation, that's for equipment. The other is unique to the oil and gas industry, and that is depletion. And that is when you purchase production reserves. Those reserves are going to be deducted under a depletion method. So once a well is in production, the participants are allowed to shelter some of the gross income from the sale of the oil or gas through a depletion deduction. Now there's two different types. The IRS gives us two different methods of production depletion: cost depletion and percentage depletion. So let me show you how these two categories of depletion work. Cost depletion is the process of writing off the cost as the reserves are produced. So it's based on a unit of production basis. So let's say that we have, in this example, let's say we buy reserves for $15 per barrel in the ground. So we're buying a property, we're paying for the reserves and the equipment cost. We can write off $15 for every barrel that's produced in a given year until the total costs are recovered. Let me give you another example, I think a better example. And this is from the AAPL land price. Let's say that you have a well that you purchased for $3 million, and it's estimated that those reserves are valued at $2.8 million, or another way to calculate it is 70,000 barrels of oil in the ground. So the first thing you do, you would calculate what your cost basis is. And all you're doing here is you're calculating the reserves that are estimated at 2.8 million divided by the number of barrels of oil in the ground. And so they're saying this estimate, according to the reserves estimate, is about $70,000 per barrel. So that, or $70,000, excuse me, 70,000 barrels of oil in the ground. So we're dividing 2.8 million by the 70,000, and that's going to give us, each well is worth approximately $40 per barrel. That's all the calculation we're doing. 7 times 4 is 28, so you can see where we're going here. So the cost depletion is for every barrel that you produce, you get to deduct $40 from your taxes. So if you sell your oil at $65 a barrel, and I know it's more today, you can write off $40 of this $65 until the 2.8 is recouped. Then you can no longer recoup, or you can no longer write off the barrels of oil. So you just have to keep track of how many barrels of oil you're producing, and then you can write that off until the 2.8 million is recouped or the 70,000 barrels is depleted. So that's a good example, I think a better example of cost depletion. Just, you can take out, if you know what the reserves amount is, you can deduct barrels from that until you really deplete those reserves, whether we're talking dollars or barrels. And then once you've used them all up, that's it. You're done. You can no longer count those as deductions. Percentage depletion, on the other hand, is really like it's really a tax shelter. It shelters 15% of a well's annual production from tax. Now, it used to be, I understand, 27.5%, but in the 70s with the windfall profit tax, they reduced that amount to 15%. Now, one thing you need to know is that it's only available to oil and gas producers of non-integrated companies. Non-integrated companies. So you need to know, let me see if I can get a pen here. You need to know that the oil world is divided into 3 phases. There's upstream, that's the work that we do. That's called exploration and production. Anything to do with land, anything to do with drilling, anything to do with production is known as upstream. At Exxon, we had our departments are classified whether they are in the upstream or whether they are in the downstream. But there's really 3 types. There's the upstream, that's what we're in. Then there's the midstream. That is the transportation. That's for tankers and pipelines that carry the oil and the gas to the refineries. And then we have downstream. And downstream is everything after that, including the refining of it, the marketing of it, and all the way down to pumping your gas at the corner gas station. That is all considered downstream. Now, a company that includes all of these together, they have upstream, midstream, and downstream. Those are known as integrated companies. That's what ExxonMobil is. ExxonMobil is an integrated company. That means they do every part of it. There's no third person that they go through. So they drill their own oil and gas. They have their own pipelines and their own trucking company, and they have their own refinery, and they refine their own gas. That's one of the reasons Exxon is so successful, is because they don't need a third party. They do it all. So they are considered an integrated oil and gas company. So this 15% shelter, this 15% tax deduction, is not available to the Exxons of the world. It's limited to oil and gas producers that are independent. That is, they're non-integrated. They don't do upstream, midstream, and downstream. And they are producers that produce, and they get the deduction on the first 1,000 barrels of oil per day equivalent, or 6,000 MCF. So if you're an independent oil and gas producer in a non-integrated company, you can deduct or you can shelter 15% of the first 1,000 barrels of oil per day equivalent, or 6,000 MCF, or million cubic feet of gas. So that's the conversion from oil to gas. Now this is limited to 50% of your net income and 65% of your total taxable income. But again, it's a significant tax shelter, again, only available to independents, and they can then decide whether they want to deplete it through this 15%. This is also called a statutory depletion because it's by statute, or cost depletion. Cost depletion or statutory tax shelter. Okay, so when we talk about depletion, there's two different options. So the way you would calculate percentage depletion is A plus B, which is your percentage depletion plus B. You don't really need to worry about B. B says for every barrel of oil that is sold for less than $20, you get to add a 1% increase. So instead of being 15% tax shelter, it's going to be a 16% tax shelter. But we don't really need to worry about that because oil has not been less than $20 for a long, long time. So as for purposes of today, the calculation is simply 15% times the gross income. That is your percentage depletion. And the advantage of the percentage depletion is it never runs out. You can do this for the life of the well. There's no 2.8 million, 70,000 barrels. Once you hit that mark, you can no longer deduct. That doesn't apply when we're talking about percentage depletion. You can deduct those costs for as long as the well is viable. So that's another advantage of the percentage depletion, but again, only limited to independent producers. Okay. Historically, tax benefits from oil and gas could potentially present the problem where you don't owe any taxes. So in the 90s, Congress came up with the alternative minimum tax. That is, no one gets a free ride. No one gets to pay no. But in the 90s, they provided some relief for this, for independent producers, and that is a company or individual with production of 1 million barrels of oil per day or less. And it's carved out of an exception for oil and gas companies. And what it says is that Tax Reform Act of 1986 introduced the prohibition. It prohibits offsetting of leases from passive activity against income from active business activity. So the distinction between active income and passive income, if you don't know what that distinction is, I want you to read a book called Rich Dad, Poor Dad, and it'll tell you what the distinction, his definition is of active versus passive income. It's a great book, especially if you're interested in being an entrepreneur. But what the tax code basically says is that you cannot deduct from your active income costs associated with passive income. So a working interest in oil and gas, however, it makes this distinction that a working interest in oil and gas or an investment in oil and gas is considered active income. So for example, whatever income I make from my business is considered active income. If I have additional income that comes from, let's say, rental properties, that would be considered passive income. So I can't offset the passive income against my active income. That passive income is not going to reduce my taxes at all. You can have active, you have an active income from my business, and you have active income, let's say, that I have these webinars, and then I also do in person. That's all active income. So I can deduct those costs incurred from active income against other active income. But if the IRS classifies the income as passive, you cannot then offset it against your active income. Okay, so here's why this is important. is because oil and gas, not only a working interest, but an investment in oil and gas is considered active income. So that's why a lot of people invest in oil and gas. I know a lot of doctors that invest in oil and gas because let's say they make $500,000 a year as a doctor, probably more, but then they have costs associated with that or other income that is active. They can deduct the other active income from their current active income. So, for example, they can, whatever investment they have from oil and gas, they can deduct that from their active income, making that $500,000 less. But if they have rental property, for example, that's going to be passive income, and they cannot offset their active income against their passive income. So the advantage is for oil and gas properties, and it is unique to oil and gas properties, is that a working interest or even an investment in oil and gas is considered active income, not passive income. And active income can be offset against other active income. So that's another huge advantage for people that want to invest in the oil and gas industry. That income that they make can actually be offset against the other active income that they have. So I just wanted you to be aware of the distinction between active versus passive and this other huge advantage of oil and gas investing. All right, so I'm going to go over these general rules again. If you're reading the AAPL text, they hit this really hard, but basically there's two types of deductions. One is capitalized deductions, the other is expensed. Under capitalized, you have two different types. Depreciation, that's for equipment, and depletion is for reserves. Salaries are always expensed. So let's look at what we talked about today. We talked about the introduction. We talked about why the IRS and the federal government wants to provide for accounting benefits for the oil and gas industry. And then we talked about the two different accounting methods. The cash basis taxpayer, that's when revenue is accounted for in the year it's received and costs are accounted for in the year paid, regardless of the year of production, or accrual, which is revenue is accounted for when it's earned and deductions are claimed when it's owed. Most companies use the cash basis method. So you don't really need to know about the accrual basis taxpayer. You only need to know if you're a cash basis taxpayer, you can deduct the cost in the year that it's incurred. And then we looked at some general rules for accounting. That's the same thing I just covered in final notes. Two types of deductions. Capitalized expenses are capitalized or expense deductions. Under capitalized, it can be either equipment, which is depreciated, but if it's production reserves, that is depleted. And then we looked at the definition of capitalized or expensed. And we basically said it's capitalized if it can be tied to a piece of equipment, then it can be amortized over its useful life, which the IRS defines a lot of times. But if it's expensed, that is ordinary and necessary business expenses that are not tied to any given piece of property. So the key question is when you can take the deduction, and again, it depends on how it's classified and what kind of accounting method you have. Then we talked about some items that can be in both columns depending on the fact pattern. So for example, G&G land costs, if they do decide to drill, those costs would be expensed. If they do all the research that they need to determine whether or not there is a viable play and they decide that it's not, they haven't incurred any costs for the leases, so those costs would be capitalized. Same thing with lease options. If we pay for the lease options, then in the oil and gas lease, those costs are going to be capitalized. If we do exercise it, those lease options are going to be expensed, et cetera, et cetera. Surface damage is the same thing. If it's for drilling, it's expensed. If it's for seismic, it's capitalized. Then we talked about intangible drilling costs, and we talked about that is everything that is either not equipment or equipment that is used in the hole. Those are considered intangible drilling costs. And intangible drilling costs can be in either the capitalized column or the expensed column, depending on what election you choose. So the intangible drilling cost advantage is that 60 to 85% of wells drilled are intangible drilling costs. So those costs can be deducted off of the cost of drilling a well, greatly reducing the risk of or the the risk of financial harm when we're talking about intangible drilling costs. So you're really not risking a $100,000 investment. You're really risking only $25,000. Then we talked about items that are capitalized. That is items that are either tied to a piece of property or production reserves. And we said there was two kinds. Depreciation is for equipment, and depletion is when we're talking about oil and gas reserves in the ground. Those reserves are going to be depleted over time, and there's two options that they can make if they elect to capitalize those items, capitalize those reserves, and that is cost depletion. That is for every barrel of oil that you get out of the ground, you can deduct that much until you hit the reserve limit. Or the percentage depletion, which is a tax shelter. It's 15% times the gross income, but again, it's only available to independents. It's not available to integrated companies. And the advantage is you can do that throughout the life of the well. There's no limit to the percentage depletion that you can deduct every year. And then we talked about the final notes. We talked a little bit about active versus passive income and the fact that oil and gas, whether you're a working interest owner who is actively involved or an investor who is not involved in the drilling of the well at all, that can be considered active income, not passive, and so you can offset that against whatever income you already have. So, and then we went over the final notes again. That is, there's two types, capitalized and expensed. If it's capitalized, there's depreciation and depletion, and salaries are always expensed. So I hope this was helpful for you, and please let me know if you have any questions, and I look forward to seeing you in the next webinar or the final exam.